Feeling stuck with your savings? Watching that $25,000 sit idly in your bank account while inflation eats away at its value? You're not alone. But what if you could turn that cash into a reliable income stream? Why let your money lose value when you can make it work for you? But is it enough to receive regular, dependable payments just for holding on to certain stocks? In this video, I will show you how to transform $25,000 into a reliable income stream through dividend investing. I will teach you the basics of dividends and dividend reinvestment strategy, the snowball effect from compounding, how to select the right stocks, and make a portfolio. In the end, I will show you how this portfolio can turn a $25,000 investment into over $10 million and pay upwards of $9,000 in dividends every month. Stick around to find out. But first, let's understand what dividend income is. Dividends are payments made by a company to its shareholders, which are the people who own its stock. Think of it as a way for a company to share profits with its investors. When you own a stock that pays dividends, you receive a portion of the company's earnings, usually every 3 months. For example, if you own shares in a company that does well and makes a profit, they might decide to pay out some of that profit to shareholders. But why are dividends so powerful for building wealth? First, dividends offer a steady income stream, especially attractive during market volatility, providing consistent returns that are reassuring for investors, especially those nearing retirement. Dividend-paying companies are usually well-established and financially stable, adding safety to your portfolio. Another advantage is growth potential, as many companies increase their payouts over time, effectively hedging against inflation. For example, a company increasing dividends by 5% annually doubles its payout in 14 years, significantly enhancing returns. Now that we have a solid understanding of dividend income, let's dive into 2 powerful strategies that can significantly enhance your returns: the Dividend Reinvestment Plan, or DRIP, and the snowball effect. DRIP allows you to reinvest your dividends back into the same company's stock instead of taking the cash payout. Over time, this can lead to exponential growth in your investment. The beauty of DRIP lies in its simplicity and automation. When you enroll in a DRIP, your dividends are automatically used to purchase more shares of the company's stock. This increases the number of shares you own and boosts the amount of future dividends you receive, creating a compounding effect. One of the greatest advantages of DRIPs is that they're typically offered without any commissions or fees. This means you can continuously reinvest your dividends without incurring additional costs, maximizing your investment's potential. Many companies offer DRIP discounts, allowing you to purchase shares at a price lower than the current market value, further enhancing your returns. Building on the power of DRIP, the snowball effect refers to the exponential growth of your investment as your dividends are reinvested and generate additional dividends, creating a cycle of increasing returns. When you first start investing in dividend-paying stocks, your initial dividends might seem modest. However, by reinvesting those dividends to purchase more shares, you increase the total number of shares you own. These additional shares generate their own dividends, which you can reinvest again to buy even more shares. Over time, this compounding process accelerates, much like a snowball gaining momentum as it rolls downhill. Let's show this with a practical example. Suppose you invest $25,000 in a portfolio of dividend-paying stocks with an average annual yield of 4% and a dividend growth rate of 5%. In the first year, you receive $1,000 in dividends. Instead of taking this as cash, you reinvest it, buying more shares. In the second year, your dividends increase because you now own more shares. The cycle continues, and over a decade or two, the growth becomes exponential. By the end of 30 years, your portfolio's value in dividend income could grow substantially, thanks to this compounding effect. The snowball effect is powerful because it leverages the twin forces of time and compounding. The longer you let your dividends reinvest, the larger your investment grows. This is why starting early and being consistent with your investments are crucial. Even small amounts of money can grow significantly over time if left to compound. In the end, I will show you how this strategy can turn a $25,000 investment into more than $10 million and generate monthly dividends of over $9,000. Now that you know about the investment strategies, it is time for selecting the right dividend stocks. This is crucial to building a successful dividend portfolio. The key is to focus on companies that not only pay regular dividends, but also have a track record of increasing those dividends over time. Here are some important criteria to consider when choosing dividend stocks. First, look for companies with a strong history of dividend payments. Companies that have consistently paid and increased their dividends over many years are typically more stable and reliable. They have proven their ability to generate steady cash flow and return value to shareholders, even during economic downturns. Next is the dividend yield. This is the annual dividend payment divided by the stock's current price, expressed as a percentage. While a high yield might seem attractive, it's important to make sure that the yield is sustainable. Extremely high returns can sometimes indicate that a company is in trouble or that the dividend might be cut in the future. Aim for a balanced yield that offers a good return without excessive risk. The payout ratio is another critical factor. This ratio measures the proportion of earnings paid out as dividends. A lower payout ratio generally indicates that the company is retaining enough earnings to invest in growth opportunities and weather any financial challenges. A payout ratio between 30 and 60% is usually considered healthy. Additionally, consider the industry and sector in which the company operates. Some sectors, like utilities and consumer staples, are known for their stable dividend payouts. These sectors can provide a defensive balance to your portfolio. However, it's also beneficial to diversify across different sectors to mitigate risks. Up next, I will show you the analysis of specific stocks that fit these criteria and illustrate how you can build a $25,000 dividend portfolio with them. To build a successful $25,000 dividend portfolio, let's analyze 5 high-quality dividend-paying stocks that fit our selection criteria: Broadcom, Cintas Corporation, Visa, Snap-on Incorporated, and Elevance Health. Each of these companies has a strong track record of dividend payments, robust financial health, and promising growth potential. Broadcom Inc. operates in the information technology sector, specializing in semiconductors. With a market cap of $732.45 billion, Broadcom is a major player in the industry. It offers a forward dividend yield of 1.33%, and the company's payout ratio stands at 46.73%, indicating a healthy balance between returning income to shareholders and reinvesting in growth. Over the past 10 years, Broadcom has achieved an astounding return of 2,150%, showcasing its strong performance and growth prospects. Analysts are optimistic about Broadcom's future, with Wall Street giving it a strong buy rating, although Seeking Alpha analysts are more conservative with a hold rating. The company's profitability is particularly impressive, with a profitability grade of A+. Broadcom's consistent growth can be attributed to its strategic acquisitions and innovation in semiconductor technology. Cintas Corporation is a leading provider of diversified support services within the industrial sector. It has a market cap of $76.81 billion and a forward dividend yield of 0.71%. Although its yield is lower than some of the other stocks, Cintas has a strong track record of dividend growth. Over the past 10 years, Cintas has delivered a remarkable return of 1,108%. The company's payout ratio is a conservative 35.67%, allowing it to reinvest a significant portion of its earnings into business growth. Both Wall Street and Seeking Alpha analysts rate Cintas as a hold, reflecting its stable but cautious outlook. Cintas's business model is centered around providing essential services such as uniform rental, facility services, and first aid and safety products. This diversified approach ensures a steady revenue stream and reduces dependence on any single market segment. Visa Inc. operates in the financial sector, specifically in transaction and payment processing services. With a market cap of $531.18 billion, Visa is a dominant player in the industry, and its 10-year return stands at an impressive 394%. Visa's payout ratio is 21.36%, indicating a highly conservative approach that leaves ample room for reinvestment and growth. Both Wall Street and Seeking Alpha analysts give Visa a buy rating, underscoring their confidence in its long-term prospects. Visa's strong market position is underpinned by its extensive global network, brand recognition, and continuous innovation in payment technology. The shift towards digital payments and e-commerce has further improved Visa's growth, providing a tailwind for its transaction volumes and revenue. Snap-on Incorporated, part of the industrial sector, specializes in industrial machinery and supplies. It has a market cap of $14.27 billion and offers a higher forward dividend yield of 2.75%. Over the past 10 years, Snap-on has achieved a return of 117%. The company's payout ratio is 36.83%, balancing dividend payments with growth investments. Snap-on's strength lies in its premium tool and equipment offerings, which cater to professionals in the automotive, aerospace, and industrial sectors. The company's robust distribution network and focus on product innovation have helped maintain its competitive edge. Despite slower growth compared to tech stocks, Snap-on's stable cash flow and higher dividend yield make it an attractive option for income-focused investors. Elevance Health Inc. operates in the healthcare sector, focusing on managed healthcare. With a market cap of $115.97 billion, Elevance Health is a major player in its industry. It offers a forward dividend yield of 1.30%, and its 10-year return is 340%. Wall Street analysts are very bullish on Elevance Health, giving it a strong buy rating, while Seeking Alpha analysts also rate it as a buy. The company's strong market position and extensive network of healthcare providers enable it to effectively manage costs and deliver value to both customers and shareholders. By the end, I will show you how this selection of stocks has the potential to turn a $25,000 investment into potentially over $10 million and deliver monthly dividends of $9,000 or more. By analyzing these 5 stocks, we can see a pattern of strong financial health, robust dividend policies, and promising growth potential. Each stock offers a unique combination of high returns, sustainable dividend payouts, and solid market positions. Now, let's discuss how to construct a $25,000 dividend portfolio using these stocks. To create a diversified portfolio, you might consider allocating your $25,000 investment evenly across these 5 stocks. This approach not only spreads the risk, but also leverages the strengths of each company. For instance, you could invest $5,000 in each stock, benefiting from Broadcom's and Visa's strong market presence, Cintas's reliable dividend growth, Snap-on's higher yield, and Elevance Health's stability and growth potential. Such a portfolio would provide a balanced mix of technology, industrial, financial, and healthcare sectors, reducing exposure to sector-specific risks. The combined dividend yield of this portfolio, based on the individual yields of these stocks, would offer a steady income stream while also positioning you for capital appreciation over the long term. As for the metrics, the average portfolio metrics would look something like this: portfolio dividend yield of 1.37%, portfolio dividend growth rate of 20.82%, and portfolio value appreciation of 20.96%. Based on these metrics, here's the breakdown of future projections for $25,000 in this portfolio. Starting with an initial investment of $25,000, if you reinvest your dividends, your portfolio could grow significantly over time. After 1 year, the portfolio would grow to approximately $30,583, including both capital appreciation and reinvested dividends. With the power of compounding, this growth accelerates over the years. After 10 years, the portfolio could reach around $187,484. Continuing this strategy, after 20 years, your portfolio could grow to approximately $1,403,836. By the end of 30 years, your portfolio could reach an impressive value of about $10,495,549. At this stage, your annual dividends alone would be around $112,912, translating to a monthly dividend income of $9,409. The total value added to your portfolio over 30 years would be approximately $10,470,549, with $9,848,600 coming from capital appreciation and $621,948 from dividend reinvestment. Don't have $25,000 to start with? Click the video on the screen to find out how to earn over $5,000 in monthly dividend income with just a $200 monthly investment.